Hello, good morning and good afternoon to all of you, to whosoever and wherever you are. And first of all, as we begin our masterclass session, would like to wish you all a very happy new year. This is our first masterclass for 2022. And the topic of today's masterclass is the power of single AR ledger. And we have with us John 𝗧𝗵𝗲, who is a strategic AR advisor and subject matter expert in Emagia Corporation. John, over to you. Thank you.
Thank you, Akshay. Welcome, everyone. Thanks for joining. Happy New Year. And as we start the new year, picked a topic that on first blush may seem obvious. But I thought it would be worthwhile to delve into it a little more deeply to really understand the disadvantages of a fragmented AR ledger and help you understand the benefits you can get if you have a fragmented AR ledger and want to change to a single consolidated one. So we'll introduce the topic, recap, the AR management challenge for this year. Take a quick look at it. And then let's talk about the role of the AR ledger. And I'm guessing, you probably haven't spent a lot of time thinking about this, and probably not a lot of discussion about this, but it is really a foundation. It's infrastructure, so to speak. And then we'll talk about the penalties of a fragmented AR ledger, review the solutions and the benefits of that solution, share with you an interesting case study, wrap it up with a conclusion, and then answer any questions you might have. Let's start off, just again, starting at level setting, as they say, managing the AR asset. Not an easy job, unrelenting task. When you think about it, the AR asset deteriorates every day unless the right actions are performed in the right quantity and the right quality. So that might be a little discouraging message to start the new year with, but it's the truth, and it's the condition we all face in managing the AR asset. That challenge is made much more difficult if you're coping with a fragmented AR ledger. And what do we mean by that? Well, the AR data is resident on several disparate ERP systems. So you can't just look at one report and see all of your AR. It's contained on 2, 3, 4, 5 different ERPs in multiple AR ledgers. And just dealing with this extracts a pretty significant penalty in terms of efficiency, but also on effectiveness. And the biggest threat is customers who purchase from several of your divisions and whose AR remains on those separate AR ledgers. So it's compartmentalized, it's fragmented. And as we'll see, that can prove to be a pretty big risk and a pretty big disadvantage. So let's look at this in context of how I view the AR management challenge this year. We see elevated credit risk in 2022, primarily because of the fade out of various government funding, subsidies, liquidity, et cetera, et cetera. And again, as we've seen here very recently, a revival of the COVID infection rate and its impact on the economy. So there's going to be some rough patches in the economy, plus a lot of the support and stimulus that was so plentiful last year and the year before no longer exists. So that's managing that credit risk. I mean, we see bankruptcies being higher in 2022 than they were in 21 and 20. And then, of course, collecting receivables on a timely basis. That's always there. That never goes away. And if you're dealing with any kind of a larger organization, inevitably you're going to have to accommodate different divisions, different business models, even if it's not a new corporate entity. You may be starting a new business with a new revenue stream, which calls for an entirely different way of managing those revenues and those receivables. And there's always the imperative to deliver an excellent customer experience, and that's continuing and elevating each year. I get the sense in a lot of companies, delivering the customer experience almost is more important than some of the traditional measures of receivables management, bad debt and cash flow and all. The other thing is accommodating work from home. That's here to stay. And it's revived again here in January. So you really need to have that capability. And of course, do it all without adding staff, right? That's always kind of the constraint. So pretty severe challenge here for this year. All right, let's step back and talk about the AR ledger. What is the AR ledger? It's the file that has every penny of AR owed by every and every open transaction, every open receivables transaction. That's the AR ledger. So in some respects, it's like a data lake for the AR asset. Ideally, it's the single source of the truth that your management and finance organization is going to rely on, that your auditors are going to rely on, both internal and external. I mean, that's the detail that supports the valuation of the account. So if your financial statement says you have $88 million of receivables, well, that AR ledger has got to show a bunch of open invoices to a bunch of customers that totals $88 million. And if that's true, that's great. Because when you validate the AR asset, you also indirectly validate the revenue you've recognized, which affects the profit. So that's a very important role, because if it doesn't, we'll get into that a little bit more, then you got real headaches, okay? Another phrase you may have heard is the age trial balance, which again refers to this listing, this file that lists all the customers that owe you money and all the open transactions. Ideally, when you sum that at the bottom, that age trial balance should equal your general ledger business balance for trade receivables. Check when you finish this webinar today, check, see if that's the case. Really needs to. And in addition to this record keeping and audit function, it's the basis for managing the AR asset, controlling the credit risk, generating cash flow, all the actions and analyses to manage that AR asset. And of course, their metrics you're reporting is derived from the AR ledger. So, statement of the obvious here, a single consolidated AR ledger is much more efficient and accurate than a fragmented one. I don't think there's any argument there. What I want to spend a little time today is for those of you who do not have the single consolidated AR ledger, is to increase your understanding of how much that's hurting you. And what are those penalties? Well, I think the chief one is inefficiency. Whenever you want to tally your total receivables, it becomes an addition, summation task. And you can do it with Excel and Access, and I know there's ways to make it fast, but it's still an extra step. And certainly for your individual collectors, anytime they want to sum up what a particular customer owes them, they have to do this, some sort of manual addition. There's an elevated risk of error with all this addition. And there's an elevated credit risk. And this is from a customer that's resident on multiple AR ledgers, not getting the attention it needs, particularly if it's a weaker customer, has a higher credit risk. To get an appreciation of the position, you need to sum up their balances on all these different ledgers. And, you know, the fact that it takes additional work almost guarantees that you won't do it as frequently as you should. And maybe some risk situations will percolate while you're unawares, so to speak. And also these multiple ledgers cripples AutoCash. I mean, geez, really hampers it. And also deduction resolution. You know, deductions are best handled when they're addressed in total. It certainly complicates data presentation on your customer care portal. Now maybe you can modify it so that it shows the balances from all the different ledgers, but that takes some doing. And if you don't, then you're displaying inaccurate information. And then the last thing here I want to share with you is the Kmart story. This is a true story. One of my clients, they had a number of unconsolidated divisions that they acquired. You know, acquisition, always a favorite thing to do. But anyway, they had, you know, 6 divisions, 6 different AR ledgers, and this one large customer, Kmart, bought from all 6 divisions. So again, how much does Kmart owe us? Well, we got to add something up. So what happened was, this is the first time Kmart filed bankruptcy. The CEO said, gee, they're a pretty big customer. How much do they owe us? And the CFO said, yeah, I was thinking of the same thing. Let me find out. And about an hour later, the CFO's got to go back to the CEO and say, well, probably won't be able to have that number until tomorrow because we got to do all these machinations to arrive at that sum. You know, certainly not the answer the CEO wanted to hear, not the answer the CFO wanted to give. So that's a pretty stark example. So what are the solutions? Obviously, a consolidated single AR. Okay, and I call this the power of one. It's all there. The trick or the key is that these individual customers who AR data is contained on multiple AR ledgers has to be summed up. And the parent-child linkage has to be accurate. So going to a single consolidated AR ledger has to be automated, has to be available on demand, and certainly need to have those robust query and analytics capabilities. So this is the solution, all right? It makes your life much, much easier. So solutions easy conceptually, but let's dive a little deeper here. Certainly your AR portfolio analysis of the total asset and an appreciation of the aggregate credit risk is much easier, much easier. Again, getting totals for individual customers, much easier. And if those are financially weak individual customers, you want to monitor that quickly, easily, and frequently. And this is where the single AR ledger comes in. When you go to allocate your accounts to your collectors, much easier from a single portfolio. Instead of saying, well, you got 88 accounts from portfolio A, 55 accounts from portfolio B, and 412 accounts from portfolio C. As I mentioned, AutoCash goes much easier. You know, your customers aren't going to pay you with a separate payment for each of your AR segments. They're going to give you one payment, one remittance advice that pays invoices from all different divisions, and it's all jumbled together. Having a consolidated AR ledger makes the auto cash run much faster. And again, with the deduction process, having that total picture speeds the processing, and importantly, the analysis and prevention efforts. Certainly enables you to provide complete, accurate data on your customer care portals, facilitates cash forecasting, and ultimately enables a global view of AR. And certainly if you've got different currencies, you'll be able to see that whole complexity in its total. And then the last thing is to properly value allowances for doubtful accounts, reserves for deductions, claims, returns, whatever, to enable the proper valuation and of those, and a proper and accurate statement of revenue and profit, which the auditors look at. With some clients that did not have that, and the auditors were focusing on what's the gross AR, what are the reserves, what's the net AR, is it really collectible, is it encumbered, et cetera, et cetera. And that takes a lot of time, a lot of stress, diverts tremendous amount of time from actually managing the AR, and is just not a very pleasant experience to go through. So that alone is worth investing to get a single AR ledger. So how does this happen? Well, technology, right? Create the single AR ledger by extracting the AR data from all the separate ERPs. So what do you need? You need technology that can interface seamlessly with these ERPs, need to be able to do it on demand, include, for a single customer, include all the open transactions, all the customer information. You know, a lot of AR systems also have a header for each customer where they list the credit limit, credit rating, sales, the last 12 months sales, things like that. That all needs to come over, and it needs to be aggregated accurately by customer, navigating sometimes tricky parent-child relationships. The technology that gets this done, well, at a very, very high level, how do you interface with these various source systems? It's the API-based integration. It could be flat file, CSV integration, or middleware. But clearly the technology exists, so why not do it? Here's a case study. Consolidated AR ledger. Here's a situation, and this is a pretty complex operation here. 3 shared service centers across the globe, 34 business units, 150 countries, 120 financial systems. So the AR was resident on 120 different systems, complicated by 14 languages, 30 banking relationships, so a high level of complexity. But the right technology that overlays all that, extracts the AR data and consolidates it, was a blessing. They deployed Emagia's AR solution, which it's the module called receivables automation, which enables this consolidated AR ledger. So once they had the single ledger, they could then move AR management, credit collection, cash app, things like that, into a shared service center. Really can't do it with disparate ledgers. And of course, that enabled huge cost savings and service improvements in the order to cash function. Right now, their indicators, AR is 85% current, auto cash hit rate, which was once devastated by these disparate AR systems, is now at 92%. I mean, 92% is excellent. And they're able to update their risk assessments of all their customers on a timely basis. So clearly some nice benefits here. So what's our conclusion? Clearly, fragmented AR ledgers create a lot of obstacles in terms of efficiency and effectiveness. And I cannot see how an organization could achieve or even coming close to achieving any of the world-class performance indicators, particularly cost. Now, Hackett's world-class performance for cost is that managing AR is 0.04% of revenue, which is very, very low. Can't do that with a fragmented AR ledger. And I think the same thing holds true with customer experience. You're not going to be able to deliver that fast, accurate answers to questions and service that customers need and should get. So as I said earlier, the consolidated AR ledger is, it's an application. It's great to have, but it's almost like it's a must-have. It's a infrastructure capability. It's a foundation. You really can't manage AR in today's economies with any kind of efficiency without this capability. You got to have that single repository for all the AR. And if you don't have it, why not make 2022 the year you implement it? These are not huge technology investments or projects to get this capability to extract the data from all the individual ERPs. And once you've got it, it will improve performance and efficiency in a host of ways that we just covered. Questions? Akshay, any questions from the audience?
We do have a first question. Let's go for it. What are the key drawbacks of having fragmented AR ledgers maintained on separate ERPs?
Well, I mentioned a number, but I would nominate two as the most serious. One is inefficiency, having to sum up amounts from different ledgers, AR ledgers, just inefficiency. But secondly, that inefficiency can lead to not managing your risky accounts as much as you should. If it's a pain in the neck to roll up their position, it's probably a pain in the neck to deal with them too. So, human nature is, well, I'll do that tomorrow. I'll do that tomorrow. Whereas it was, consolidated for you and easy to analyze where the exposure was, gauge the risk, quantify the risk. My gut tells me human nature would make it so that those problem accounts receive the attention and scrutiny that they deserve.
What are the alternatives or solutions to address this specific problem?
Well, the one solution that a lot of companies are forced into is just a network of Excel and Access files that will download information from these various AR ledgers contained on multiple ERPs and attempt to sum and construct a somewhat consolidated AR ledger. That's kind of a interim stopgap solution. The real solution, and the solution that will enable a manager of AR to manage well and efficiently, is software application that accesses all the individual AR ledgers on all the different ERPs and ERP equivalent systems and pull it all in together, aggregate by customer, and present it in one consolidated file, which, by the way, also makes analysis much, much easier. And, when you're dealing with large exposures, weaker credit customers, you need that analytics, you need that data, and you need to look at it in different ways to really understand how serious the threat is and what you need to do to mitigate it.
Thank you, John. And can you put some light into the major benefits of having a single consolidated AR ledger?
Well, I think first one is efficiency. Again, not having to sum up all these different sums, but also we see what it did for AutoCash for that case study. I mean, if you're automatically applying 92% of remittances, you've basically eliminated the need for people in that function, and you can deploy them elsewhere. So that's a huge productivity function. Similar, though not as great, benefits can be gained in deduction processing from having a single AR ledger. Again, avoiding the summation and all that stuff also adds to the productivity. And then, again, the visibility is key. The complete visibility over the longer run will benefit and reduce the credit risk and reduce credit losses.
Thank you, John. Let me just open it up for a few more questions with the audience because we have a few more minutes. We'll wait for about a few more seconds.
You know, that Kmart story I told, you know, I mean, that can happen. It did happen. And, you know, not having quick access to the right data to enable you to give the right answers quickly is a problem. And the single consolidated AR ledger, the power of one, eliminates that.
Right. That's actually a very good story that you did, or a use case, I would rather say, that you bring in terms of looking at having a consolidated AR ledgers and all. But yeah, I think we are almost through with our schedule for today. Thank you very much, John, and appreciate you going through this session, our first session for 2022. And I'd also like to thank all the participants. I would also like to invite you all for our next session on Thursday, the 20th of January at 8 a.m. Pacific time. The topic for our next masterclass session is how to minimize the impact of rising interest rates in 2022. And if you do have any questions that you want to reach out to, please do send us an email at info@emagia.com. Look forward to seeing you all in 2 weeks from now. Thank you very much. Thank you, John.
No, my pleasure. Thanks, everyone. And don't be shy with any questions. Happy to get them and answer them for you. Thank you. So long now.